All financial advice provided on this show is for entertainment and educational purposes only. The financial ideas and strategies discussed are only provided as a starting point for a conversation about money matters. With regard to your particular investments and financial strategies, consult your financial planner, CPA, or investment professional. All your financial decisions are yours and yours alone to make, and subsequently are solely your responsibility. The information that is supplied through the context of the radio program and any repurposing of its content by the host or network is a combination and collection of solid financial investment understanding, opinion, and comments. This network, show, and its host are not liable for financial strategies, outcomes that you employ in any manner that result in any kind of loss. Shares of corporate sponsors may be the subject of buy or sell recommendations in Jay Taylor's newsletter in accordance with Jay's objective opinion.
Welcome to Turning Hard Times into Good Times with your host, Jay Taylor. This hour will help investors fix issues and achieve personal gain. Now, here's your host, Jay Taylor.
Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as usual, I'm speaking to you from the borough of Queens in New York City. It is the first day of November 2022. Before I talk more about today's show, let me remind you that I am the editor of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks, that is focused mostly on providing research and coverage of junior gold and silver exploration stocks. I do, of course, also comment on the economies and on various markets, and certainly refer to the guests on this show very often in my newsletter as well. You can go to miningstocks.com to sign up for my letter. We like to also promote Chen Lin's letter, What is Chen Buying, What is Chen Selling? Go to chenpicks.com if you're, especially some very exciting biotech stories that Chen covers. And Michael Oliver is not with us today, but we also like to plug Michael's work, olivermsa.com. I want to thank all of you for listening to the show and also encourage you to send along whatever comments you have to questionsfortaylor@gmail.com. Questions, the number 4, taylor@gmail.com. Also, we, of course, want to thank our sponsors. They make this show possible. Our sponsors are Irving Resources, Novo Resources, Gold Bull Resources, El Oro Resources, Rena Gold Mining, and Timberline Resources. Is America facing its second Fed-created depression since 1913? Well, that was the title to my newsletter that was sent out to my subscribers yesterday. A picture is worth 1,000 words, they say. Unfortunately, since this is an audio format, I can't show you a very important picture that was displayed recently by Lance Roberts in an interview that he did with Adam Taggart on Adam's Wealthion channel. But let me explain it to you since you can't see it. I'll do the best I can to give you the picture in fewer than 1,000 words. The chart shows a dramatic rise in consumer credit starting in 1959, which, as I recall, as a very young person then, very few people in America took on any credit unless it was to perhaps a bank loan to buy a house. And even then, most very large down payments were put into that house, or maybe to buy a car. So for bigger purchases, some people borrowed money directly from the bank. Even then, it was required. The banks then often would require co-signers, somebody to back up the initial payer. I can recall as a young lad, in fact, when my father bought a house, I think the price was around $17,000 or $18,000 in Dalton, Ohio, back in those days. And my Uncle Paul, local farmer, had to co-sign that note. And of course, the bank was looking at Uncle Paul's farm and the value of that farm as a means of paying if my father couldn't pay. The point is, back in the 1950s, Americans didn't borrow any money other than to help finance some of those major purchases that I just noted. During the 1960s, well, that was the first time that people started using credit cards, and then only to pay back whatever they owed every month. People didn't run up big lines of credit and never pay them back, as people do these days. So the chart that Lance Roberts shows started with zero consumer credit in 1959, which is pretty much I think if you put all the total credit on a chart, it would be hard to see the amount back in 1959 compared to where we are today. But that went from essentially zero credit per capita to $13,796 per capita per U.S. citizen or U.S. persons at the present time. Now, that wouldn't be a big deal except that from about the year 2000, consumer income and savings began to decline. And then immediately after the financial crisis, per capita income and savings for average Americans no longer supported their cost of living. In fact, as the chart shows, the gap between real disposable personal income and savings is now plunging way below the cost of living. That we're talking average, per capita average, the per capita situation in America. And of course, we are not even beginning to talk about federal debt, which is also skyrocketing, so that the average debt American citizen now owe is $93,754. I just checked the debt clock a little while ago before coming on the show. And if you're a taxpayer, well, your average debt is $247,882. And this accelerating and rising very rapidly, of course. It seems to be getting out of hand with COVID and more recently with the war in the Ukraine and the problems that have resulted from that, inflation issues and so forth. Well, propaganda from both major political parties has most Americans believing that the Fed was created to reduce economic risks and market volatility and also to create full employment and maintain stable prices. That's what we're told all the time. That's what their mandate is. I would say that they have failed on all counts for at least two reasons. First of all, as we should have learned from the USSR and other socialist experiments, it's impossible for governments to devise a perfect economic environment. It's impossible for the Fed to do what markets do perfectly, namely to define an equilibrium price for interest rates. Secondly, the Fed was in fact not created for those stated goals. It was created by and for the benefit of its shareholders, the money center banks and the wealthy elite that controlled those banks, such as the Morgans and the Rockefellers and other elites of that day back in 1912, 1913. The 2008-2009 financial crisis served as an inflection point for our country as the Fed came to the rescue of its shareholders, the money center banks. And so as the Fed created hundreds of billions of dollars out of thin air to protect the banks and other major elites of our society, a threshold point was reached where incomes and savings, on average per capita, reached the point where they no longer support the living standards of a major portion of the American citizenry. And so millions of Americans sought to make up this gap. They are doing so now by borrowing even more money, causing an even greater acceleration of total debt to GDP. Then a decade later, as just noted, COVID follows. We get the COVID problem, and then we have the extremely destructive sanctions placed against Russia. And that has put America's very existence, I would argue, in question, whether destruction comes by way of an economic depression or nuclear annihilation. It seems there is no appetite from Americans, at least the elites, to seek any peaceful solution with Russia, and it doesn't seem as though the citizens are really caring much about that issue either. Well, and it's not hard to understand that because, after all, since 1971, when gold was detached from money, the American empire has been able to expand endlessly thanks to the Fed's fiat printing press and the American taxpayer, who is taxed directly or indirectly through inflation caused by trillions of dollars created out of thin air by the Fed. A glance at Lance Roberts' chart suggests that America's days as a financial empire, and thus as a global superpower, may be nearing an end. As the masses of voters enter poverty, what is the Fed to do? What is the government to do but to create even more and more money at a faster and faster rate of speed in order to keep citizens bearing torches and pitchforks from seeking revenge? But printing more money will only provide very short-term relief. As we've seen, the Fed has been doing nothing but kicking the can down the road, not fixing anything, just putting bandages over the injuries. Because the Fed has destroyed price discovery of capital by manipulating interest rates to zero, causing capital to be allocated to worthless endeavors while the debt used to manufacture fiat money remains to be paid. So now the amount of new money that must be created to generate $1 of new GDP has been, the amount of new money that must be created to generate a new dollar of GDP has been increasing rapidly, but in fact is doing almost no good. In fact, you can argue now, I believe, that each dollar that's created actually does more harm than good because of the debt and the inflation that is resulting from it. Well, suffice it to say that when money costs little or nothing at zero interest rates, capital is misallocated into endeavors that are non-economic. Because the Fed has lowered rates for decades on end, poverty now sits on our national doorstep. Where does all this place gold and our gold share investments that we talk about on this show so frequently? Well, according to Bob Hoye, who will join me in the second part of today's show, we are getting very close to the time when gold and gold shares will enter a multi-year bull market. He is especially bullish on the junior gold exploration stories like those that sponsor this show, like Timberline Resources. It's a company that you will hear more about in just a few minutes when we come back from our first commercial break. Some of you may be familiar with the company named Snowline Gold. It is one of many gold exploration stories in my newsletter that I believe are on to a world-class gold discovery. And there are many others besides Snowline. There are several others that I'm really bullish on. Timberline being one of them. And as I said, we'll be hearing from Timberline in just a minute or two. It seems very reasonable to expect Snowline to outline something perhaps on the order of 20, 30 million ounces of gold from its project in the Tintina Gold Belt. But there is another Tintina Gold Belt story that I have just written about in my letter. I learned to know about this story after Quentin Henning suggested there was another prospect with the same kind of potential, the same kind of geology and mineralization as a Snowline project has. And I have just started covering that story in my newsletter, and I hope to have that company on the show sometime in the future to talk about it. But if not, you can learn more about it by subscribing to my newsletter. Go to miningstocks.com to do so. That new company I'm talking about is selling at a mere 12 cents a share. Of course, right now, people aren't interested in these gold shares at all. But if the main theme of this week's show, which is a new gold bull market, is underway very soon, then I think a lot of you are going to be sorry if you don't already own some of these primary and really good stories. You're going to be sorry you haven't done so. In today's show, as I say, Bob Hoye and Patrick Highsmith return. Patrick Highsmith will be talking to us about Timberline in just a minute. Bob Hoye says the bear market in gold explorations is about to end, and so we'll hear why he thinks so in the second half of today's show. We do have to go to break now, but don't go away because Patrick Highsmith will be with us to tell you why you should pay some attention to Timberline Resources. Don't go away. We'll be right back with Patrick.
Lion One Metals is focused on high-grade gold in Fiji, led by legendary Canadian financier Walter Barakoff. Lion One is permitted for production and drilling for discoveries in one of the most exciting high-grade gold projects in the prolific South Pacific Ring of Fire. Lion One trades on the TSX Venture Exchange under the symbol LIO and on the OTCQX under the symbol LOMLF. Go to our website at liononemetals.com for more information about Lion One Metals and high-grade gold in Fiji.
You're listening to Turning Hard Times into Good Times with your host, Jay Taylor. If you have a question or comment about today's show, Jay would love to hear from you at 1-866-472-5790. That's 1-866-472-5790. You can also send an email to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. Now, back to our program.
Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Patrick Highsmith with us once again. He is the president and CEO of Timberline Resources and a very experienced professional geologist, mining executive with 29 years, I don't know, maybe it's more than that now, at least 29 years of experience. And he's worked with major household name companies like Rio Tinto, BHP Billiton, Newmont, Pure Energy Minerals, Fortescue, an Australian company. Has worked on more than 250 projects. He's been involved with the financing of various transactions that he's been involved with. So he's sort of well-rounded in the mining sector, from soup to nuts, as they say, or from exploration to production. So it's really good to have Patrick with us today to talk about Timberline Resources. Trades in the U.S. under the symbol TLRS. You can buy it in Canada under TBR. 159.7 million shares. Saw this morning selling at about 11 cents in U.S. money, giving it a market cap of between $17 and $18 million. So it's really a microcap stock. It's a microcap stock that is on to, I think, what could be a very exciting story, very exciting exploration discovery. It is a discovery for sure. It's the question now is it got the scale to make it really very valuable? And I think it certainly has the potential to, which is why I'm really happy to own the stock myself and to have it in my newsletter, and also, of course, to share this with you. So thanks for joining me, Patrick. Good to have you again.
Good to be here, Jay. Thanks for that introduction.
You bet. So Timberline is exploring what I believe is described as a Carlin-style gold project. Can you quickly describe in lay terms, for those not familiar with your project, it's the Eureka project in Nevada, maybe the characteristics of a Carlin-style gold deposit, and explain why they can be of considerable size, and some of them are extremely profitable, I know.
Sure, Jay. Timberline, as you say, is a Nevada explorer searching, really focused almost exclusively on Carlin-type gold deposits. And a thing to remember, Jay, about those types of deposits is they occur in several large trends in Nevada, and we are one of those on-trend explorers in the Battle Mountain Eureka trend down near the town of Eureka, for which our project is named. And Carlin-type gold deposits, Jay, are sediment-hosted gold. They're hosted in rocks like limestones, shales, dolomites, and variations thereof. It gets a lot of jargon in there, but those are sedimentary rocks. They have occurred by the fluids reacting with those rocks, Jay, and sort of eating their way into the rocks to make their own porosity and permeability. So these are highly reactive sedimentary rocks that receive these gold-bearing fluids. The gold there is associated very commonly with elements like arsenic. You'll hear us talking about that on videos and in our news releases. The presence of arsenic is a good thing when you're looking for gold, that sort of thing. And I guess to characterize Carlin-type deposits in a couple of sentences, Jay, they tend to be large-scale, kind of consistently mineralizing these rock units over large distances, along these trends. They can yield excellent grades and favorable economics because of their both scale, their size, and their grade. So they're often a target for the major mining companies like Barrick, for instance.
Right. Well, I understand you just finished drilling at Eureka last week, and that you are still waiting for all but about 4 holes. What can you tell us about? Well, I know that you talked to us on September. You actually were on the show September 13th, the day before you came out with some pretty interesting, very, very significant assay results from 4 holes, the first, I guess, 4 of 20 that will be reported on. Can you talk about the results from those holes back on September 14th? And then maybe comment on the remaining 16 or so that you're waiting for assays on.
Yeah, just a refresher there, Jay. We did just complete drilling about 7,000 meters. As you say, it's about 20 holes, and we released in mid-September the first 4. And you'll recall our project is called Eureka. We do have a 500,000-ounce resource there that was reported under the Canadian 43-101 rules some years ago. But that was a lower grade part of the system, and we've been drilling what we believe to be the down dip sort of roots of that system in a new discovery called the water well zone, which is new. It will be outside and additional to the resource if we're successful there. And the water well zone really got things excited back in the first quarter, Jay, when we announced around 44 meters of over 4 grams from one intercept, and then we went 400 meters away and we drilled 41 meters of 5 grams in another intercept. And since then, we've filled in and added on, and that most recent intercept or press release that you mentioned We announced 4 more holes, and I guess the headline there was we drilled one hole with about 23 meters of 4.3 grams per ton, but that included a 7.6 meter run of 11.6 grams. We had another hole with 18.4 meters of 3.8 grams. That, too, included some high-grade, 3.3 meters of 13.3 grams, Jay. So each of those 4 holes had significant gold in it. Each of it had the characteristics of this water well zone, this Carlin-type deposit, and they 3 of the 4 had assays 10 grams per ton or better. So we're kind of consistently hitting high grade, and we're expecting to see some more of that as we finish up the reporting, as we'll probably do more of those releases, Jay, with groups of 4 or 5 holes, mostly around the water well zone over the next few weeks. Probably in the next 2 weeks will be our next release.
Well, certainly as you keep drilling and you keep hitting those kind of numbers, I mean, those are very Carlin-like numbers I think I've seen with some of the other projects. I guess the level of confidence should be increasing in the market, and I'm sure it is with the geologists that are looking at the project. I mean, that's part and parcel to the economics of a project. That's something else. And of course, recognition, and even getting people to pay attention right now, because gold shares are so unloved at the moment. But I think at some point when things start picking up, people are going to wake up and realize that there's a pretty good probability you're onto something significant here. We'd like to ask you perhaps to comment on the footprint of this whole Eureka project, to give us a sense of the scale, because I know from experience, learning the hard way when I was new in this business years ago, that bigger is better. And for the economics, generally speaking, you have to have the scale because the overhead costs, just putting a mine into production, the time, all the things that go into putting a mine into production are very costly, very time consuming. So could you give us a sense of what you're looking at, the scale of what you're looking at, and these targets that you've laid out?
Absolutely, Jay. At Eureka, we're playing with the big boys. This one property is 70 square kilometers. We own almost 60% of the claims in the Eureka district. Of course, with our friends to the north at I-80 Gold owning a very important chunk of the northern part of the district, where they have over 9 million ounces of historic production plus resources. The resources alone are about 7.7 million ounces up there. So this is a big district, Jay. It's already sort of a 10 million ounce district. We're a major claim owner there. And really what's exciting, and the audience can see these sort of numbers and these maps I'm going to refer to in our news releases, but also in our presentation. We have at the Lookout Trend just one of 3 intensely mineralized areas where we have drill indicated gold. Over 4 kilometers of strike of gold, about 3.7 kilometers in the resource itself. If you include the areas outside of the resource, it stretches for, I think, up to about 6 kilometers of drill indicated gold on that trend. And so, as you say, the footprint is there for a lot of gold along this structure and very little modern drilling, Jay. Sure, in the 80s and 90s when Nevada was so hot, there was exploration done here, but and that's where most of this drilling came from. But that was just shallow depths. And by that, I mean 100 meters, Jay, super shallow, okay? So the water well zone begins at about 140 meters, continues down to about 320 meters so far. So still, comparatively shallow for the big mines in Nevada these days. So we feel like with the footprint we've got so many targets to chase those early drill indications to greater depths. We've been spending a lot of time sort of validating our model. Do we see the same horizon consistently mineralized over the water well zone? Well, yes, we do. We've been talking about the Dunderberg Shale, for instance, hosting the gold here. It's the same gold unit that hosts a lot of the gold that I-80 Gold has been drilling to the north. It's consistently mineralized along this section for over 1 kilometer every time we drill it in the guts of the water well zone and beyond. We're hitting gold. And so we've got those earmarks of scale, as you suggest, Jay, that's really important. Several kilometers of strike, going down dip to greater depths, we continue to see it. And so fortunately this year, we raised money at 25 cents at higher prices before things sort of softened so much for the summer. So we had a good treasury, Jay. We were able to drill these holes. Sure, the market's been very soft this summer, but we've been able to drill and crank out results, and we'll face the fourth quarter here with lots of news flow. and we didn't have to dilute our shareholders at these lower prices, so we were able to get money at higher prices and do this drilling. So filling in that model, understanding it better, and that really sets us up well for getting these results out. And as you say, we'll watch to see how the market greets the results between now and December. But certainly it set us up to be a busy season in Eureka, continuing right through, as I'm sure I-80 Gold will keep drilling through the winter. I expect that Timberline may well be drilling some in the winter, but certainly drilling hard again in the spring of next year.
Yeah, I-80 Gold. I watch it. It's in my newsletter. I love that stock. I have shares myself. I think you and Downey did a joint video, if I'm not wrong, and you must trade notes with him, I suppose.
Yes, Ewan and the I-80 team are at obviously a very different place than we are. They're developing mines in Nevada, but Ewan knows, I think, as well as any big developer does, exploration is the pipeline that feeds this mine production. So we hosted a webinar together with Ewan. That's probably out there on YouTube for folks to look up, the two of us both talking about our projects. And it's a great way to think about Nevada. You have these big trends, and when you're in the right rocks, look at these districts that are the most endowed with a lot of gold, preferably high-grade gold. In this case, Ewan and his team has been drilling high-grade silver, lead, zinc mineralization also, and Timberline has also reported silver, lead, zinc mineralization from the Eureka project. Multiple kinds of mineralization often characterize these world-class gold districts. An older silver event followed by the later Carlin-type gold event kind of mimics what I-80 Gold is seeing to the north, and hopefully we drill grades as good as theirs. They've drilled some bonanza grade stuff, silver, and we haven't yet. But a lot of similarities because, frankly, this Eureka Gold Belt, Jay, stretches from Timberline's project in the south right through I-80's project in the north, and that's really the corridor of rocks that has been home to all these good drill results from both companies over the last year.
Yeah, you mentioned the silver and base metals, I think silver, lead, zinc. Maybe you have discovered a carbonate replacement system there on your project. Any plans to do anything with that? Are you planning to drill that, or are you just going to stay focused on the gold and try to prove up some significant high-grade resources now?
So far, the shallower high-grade silver occurs on the northern block of our claims. We'll probably be talking about that in the next quarter. We've done a little bit of prospecting up there, and we'll get those results in and probably report those in the next quarter. But as for drilling, the silver, lead, zinc we've hit so far has kind of been the roots of our system, Jay, not the higher grade portions. So we see the silver, it's interesting, but we're kind of vectoring from that towards the higher grade gold as best we can and trying to figure out that relationship. But I suspect that this next round of drilling, we probably will see some silver. And we always like to remind the audience, we are gold explorers. We believe the future of the big mines in Eureka will be gold. However, this silver, when it occurs in these high-grade compact lenses, can certainly yield economic production as well. So we're going to have to see what the rocks tell us, Jay. We're going to have to listen to what the rocks say and what the assays say. But I would say expect to see Timberline hitting some silver, lead, zinc as we get more into the system. We've drilled the southernmost known silver, lead, zinc in the district down here on our project. But we're going to be focusing on that high-grade Carlin-type gold, and who knows, maybe we'll complicate Ewan's life by finding another high-grade silver thing in the can because I know he loves those type of deposits. So
I'm sure he'll be glad for that kind of complication. Well, just with about a minute left, can you give us a sense of the timing? What are you planning to do the remainder of this year and into 2023? What are your targets? What should people be looking out for?
Well, first and foremost, we're going to push these results out in sort of logical groupings of holes. I expect the next release in the next 2 weeks, another release in maybe late November or early December, depending on where Thanksgiving and the news flow falls. And then we'll have at least a third news release on drill results in December. Could roll over into early to mid-January, but we're trying to get all the numbers out of the labs, Jay. And that involves a lot of interpretation, a lot of map making, and new figures so people can kind of learn how to put these numbers in context. Each time we report them, we're trying to educate where these things and how they fit together in this jigsaw puzzle of a new discovery at Eureka.
Very good. And we're thankful that you're here to help us understand that on my show as well. Okay, well, we'll have to leave it go at that. We're out of time, but thank you very much. I think you've covered the story pretty well in the short time that we have here, Patrick, and I wish you all the best, and I'll be watching very closely in the next couple of weeks for those assays, that's for sure.
Absolutely, Jay. Thank you, and good luck to everyone.
All right, thank you very much. Well, folks, we do have to go to break now, but don't go away because Bob Hoye will be with me. And, we're kind of hoping that Bob is right because he thinks the gold bull market is right around the corner. Yeah, you might have heard that before, but Bob's track record is very strong. So I wouldn't dismiss what he has to say, and that's why I wanted to have him on, because I thought we could use some good news for a change in this sector. So don't go away. Bob Hoye will be with me right after the break.
Timberline Resources is a mineral exploration and resource development company focused on gold discovery in the world-class mining jurisdiction of Nevada. The company's flagship Eureka project hosts a significant gold resource and drill-indicated upside potential at nearby higher-grade targets. Timberline Resources trades in Canada under the symbol TBR and on the OTCQB in the U.S. under the symbol TLRS. To learn more about this district-scale asset with exciting discovery potential, please visit www.timberlineresources.co.
You're listening to Turning Hard Times into Good Times with your host, Jay Taylor. If you have a question or comment about today's show, Jay would love to hear from you at 1-866-472-5790. That's 1-866-472-5790. You can also send an email to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. Now, back to our program.
Welcome back, Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Bob Hoye with me once again. It's been quite a while since Bob was last on the show, so let me just give you a little bit of a background on him, and maybe quite a few of you who are not familiar with him. He has a degree years ago in geophysics, and he worked as a young man for various junior exploration companies and during the summers. And then I guess he spent one winter in the bush, and he said, that's enough of that, and he decided to do something different. Then he went into the financial markets and started, he was on the trading desk and in research, did research in a department with a large investment dealer in Canada. Bob's review of financial history provided the forecasting models that he's found very useful and has used over the years. He looks at significant trend reversals during periods of alarming volatility, typically during the transition from rampant speculation in tangible assets to fabulous speculation in financial assets as well. And, of course, the other side of it is that dreadful post-bubble contraction that some people have had just a tiny taste of, it seems, but some people think that there's a lot further to go. We'll get Bob's view on that in a moment, I'm sure. So he combines technical work along with economic analysis. He's a great student of history and looks at the big picture as well as shorter term moves. But I've known Bob over the years as one who looks at the big long term what's happening in various markets. And those periods of transition are very important because most people don't catch them. I think we tend to think that what we've experienced in recent years is going to continue forever, but that's why it's important to study history to learn that that's not true. Bob writes a weekly overview of pivotal events, which is just now calling for a multi-year bull market in the gold sector. So, Bob, I'm really happy to have you. Thanks for joining me. We want some good news for a change.
Yeah, Jay, thanks a lot. Yeah, I'm going to say right off the top here that a great financial bubble changes the world on the way up because people discover, hey, this is the way to get rich, and then it reverses and goes down. But it has an influence on gold and gold stocks, see, because there have been each of these great financial bubbles, of which the latest is number 6. The first was the South Sea Bubble in 1720. And I found decades ago that there were common features in each one. And one of them is the real price of gold. In the senior currency, and for 100 years or more, England was on a gold standard. So you think the price of gold is fixed. But then when you deflate it by the CPI, you find that, hey, it does things. And what it does in the final stages of a great financial bubble is that the gold's real price goes down. Mm-hmm. And it did. And the latest posting is always, of course, a month or so behind because you're dealing with the U.S. CPI. And it is still going down. And the reason we follow the real price is that it reflects profitability of gold mining. And I'm going to take a jump here, Jay, that people can readily understand, is that between mining and running a mine and the mill takes a lot of energy, and that relates to crude oil prices. And then blasting agents and all that sort of stuff. So maybe 50, 60% of the cost of mining is energy. And if you've got crude oil falling relative to gold, that side begins to look a little better. So this is where we did it. Now, the gold's real price is still going down. But if you take a look, and we did this in June, took a look at gold divided by commodities, specifically the CRB. Now, in June, July, it was bottoming. It was generating all kinds of downside capitulations and selling pressures and all that sort of stuff. So looked at previous lows in that, let's call it an indicator, and they had a tendency to lead the next rally in the sector by up to 4 months, which then counted out to around October. So this is what, since last summer, we were thinking there was a probability that the downward pressures on the gold sector would continue into October. But and they have. So and then the latest update on gold divided by commodities, it's in a pattern we really like, where you get an oversold, which was June, July, and then you get stability, base building. And we found this in the past. That can run for around 5 months. And then when you got whatever you're watching, it starts to rise above the 20-week exponential moving average. That concludes the base successfully. And, for example, we used this in the first half of 2021 on the U.S. dollar index, the DX, and that worked out well. And then we've also used it, I think, at the same time on the gold-silver ratio, and it was bottoming, so that was good. So the issue is that the profitability of mining depends upon the spread between bullion price and their costs. But now it's only in the last few months that I realized that the standard method of looking at gold stocks is to look at the U.S. dollar, condemn the Federal Reserve, which I join, and say that the U.S. dollar is going to crash and gold's going to go to 10,000. But that hasn't been working lately. But what you then if you're buying gold stocks on the prospect of the U.S. dollar going down, you're effectively speculating in foreign exchange markets. But if you look at our way, where you look at the real price relative to CPI or relative to commodities, then you're looking forward to an increasing stream of earnings. And when you're buying an increasing stream of earnings, you're investing in that industry. Now, with this, as I said, with gold's real price going down in each bubble and then going up, you've had copper do the opposite, and back to 1825, and copper's real price has deflated, goes up in the final year or so of a great financial mania, and then it turns down. So this is where, in such a boom, you make money on the base metal miners, and you're going to underperform with the golds. So there's no point being in golds through the final stage of the bubble. And then the irony, Jay, comes in when you get the financial pressures that really end the bubble, which has been on. Then it hits the gold stocks. So we've seen in the last couple of months a washout in price on the main gold stock indexes. And also, as you know, the whole junior exploration side took a hit that I haven't seen one of those in ages. So the sector is really, really crapped out. Now, what I want to do is look ahead to when and we're using gold divided by commodities, when it finally pops up. Now, for the last few weeks, we have suggested to our subscribers to begin quietly accumulating gold stocks. That would be from seniors to juniors, but not to get fully positioned until a few of our indicators come into place, like when we conclude the successful base in gold divided by commodities. Now, I want to take the next step, which is one can see how readily for mining, if you've got a lid on costs and the bullion price is doing okay, then you're making money. But that's for producers. But just the fact of the real price going up is also enhances the valuation of a prospect in the field. If you've got a good-looking mineral deposit and the value, or the relative value of it's going up as the price of gold, real price of gold goes up, it enhances the exploration side. So this is the foundation of our long-term thing here. So what we are, we thought that maybe the bottom could be around October, and it's getting stretched out, and we've got an indicator that will, when it turns up, we will get more aggressive. Now, here's the next thing we want to look at is that previous post-bubble contractions after 1929 or after 1873, 1825 was another one. One of the features was a long period of weak commodities, weak wholesale prices, weak purchasing or power for earnings for ordinary companies and industry and stuff like that. But with the real price of gold going up, you go into then a long bull market for the sector with, who knows, previous post-bubble contractions have lasted for 20 years in that order. But the usual 3 to 4 year business cycle keeps coming and going, and it continues. So with some cyclical interruptions, the bull market in gold's real price is multi-year. But you also have to have the golds won't go up when the S&P is crashing. But once it stabilizes, and then it starts to go. So here's the other thing about let's talk about the GDXJ as being representative. So once it gets in its uptrend, it's not just going up, but it'd be likely outperforming the S&P. And for all the years I spent in the institutional side of the street, I know that equity fund managers, they may be running a portfolio that doesn't include gold stocks. But you have 2 quarters with the GDXJ outperforming the S&P, there's going to be many fund managers who say, hey, I got to get aboard. So that then, of course, that's ahead from whenever it really starts to head up. So this points out that our outlook, once bottomed and turned, is extremely bullish for the sector. And from time to time, it'll be really hot. And then also from time to time, there'll be major discoveries. they happen.
Mm-hmm.
Now, we're going to back up a bit, just like go back to 1929, and Homestake was the premier producer then and was producing gold at a pretty well constant rate. And, of course, their stock got hit with the crash, and then its stock stabilized around $9 in 1930, 31, and you could accumulate the stock at that level. So what I did was took it to the end of 1932 because Roosevelt didn't start messing around with gold until March of 1933.
Mm-hmm.
So by the time you got to the end of 1932, the S&P had been trashed, of course, but Homestake stock was up something like 130% from the $9 level, and their earnings were up about that as well, but the price of gold was still $20.67 an ounce.
Mm-hmm. Mm-hmm.
But the reason why the gold sector was making money was because their cost of operations reduced with base metal mining and smelting operations being shut down. There were miners available, there was equipment available, so their supplies were cheap, and the gold sector was making money, and it continued. So take it further, then in 1933 is when Roosevelt was fooling around with the price of gold. They thought by raising the price of gold in U.S. dollars that it would help commodity prices, and that would help farmers. That wasn't working. So then what they did was enhance what was going on, which was the real price going up. So then that really put the real price further up, and Homestake eventually in the mid-1930s was trading at $65 a share from your $9 accumulation. And then also, Jay, get this, that in those days, gold miners paid out virtually everything by way of dividend.
Yep.
So through the mid-1930s, on your $9 purchase, you're getting $4.50 a share annually dividend.
Well, Bob, it took a depression. It took a Great Depression. We've some people have said we've got the bubble, the mother of all bubbles here.
Yeah.
Do you think I don't say this cheerfully by any means, but do you think we could be seeing something akin to something really dramatic on the downside that's hard to envision right now? Of course, most people think that governments are here now to fix everything, and they weren't there in the 30s. And we had the gold standard, which they blamed for the Depression, which, of course, is a lie.
Yeah.
But that's what people think. That's the propaganda. But what are your thoughts? Is it going to, are we in for something very significant on the downside? Because I looked at this morning, I think that the S&P is only down about 18%.
Yeah.
From the start of this year. This is not much of anything has hit us yet.
Yeah.
And yet when you look at all the things going on in the world, you'd think that maybe we're in for something more difficult.
Well, you've got the intrusions by crazed governments so that they had the lockdown within the midst of a bubble, and that then put a hole in the economy. And then maybe the strong, relatively better GDP number for the third quarter, maybe some of that, I know some guys are saying it was inventories and screwing around and stuff, but maybe it also was helped by folks just sort of getting back to normal.
Right.
Okay, now every post-bubble contraction has been severe. It's like it's a change your world on the way up where everybody becomes prosperous for a while, and then it's a change your world on the way down. Now, in 1929, the S&P and the Dow, they fell to the low in July 1932, was sort of 85 or 87%. Now, at that time, the New York market was junior relative to London. And the speculation was wild, and that was the crash. Now, in London, their representative stock index fell in half. Bad enough, eh?
Yeah.
So the post-bubble contractions are change-your-world stuff. You have chronic pricing pressures in most commodities, and let's say wholesale prices, and industry and commerce has a tough time with pricing, and so you have and then you have a problem with companies servicing debt, and you have even debt junk bonds being going no bid in default, and then you have many investment grade bonds going to junk and then to default. So it's just plain ugly.
Yeah.
But through it is the feature of gold. So one would wonder why in a post-bubble contraction the price going up. Now, what does it do? Well, it makes the business whole more prosperous. So gold production numbers go up. Mm-hmm. And they can go up hugely. And where does the gold go? Well, it goes into the financial system, and it starts to restore liquidity in the banking, where the previous liquidity of all kinds of debt instruments had gone zero, went around. So Mother Nature has a plan for gold, and all of the economists out there, interventionist economists and interventionist central bankers hate gold. But the rise in gold and the increase in production will begin to restore liquidity in a blitzed out banking system, and it's happened every time. As a matter of fact, Jay, there's amazing numbers on 4 out of the 5 major contractions in England, in sterling, and that was the senior currency, the rise in the real price of gold on the lengthy, like the 20-year, was 1.7 times. And it did it 3 times.
Yeah. Bob, we're just about out of time here. Here already. There's so much more to ask you. I've hardly asked any questions, but I want to ask you. I want people to know. So essentially, I think on commodities, you use the CRB, and how do people know? I mean, they can subscribe to your letter, and tell them how they can do that.
Oh yeah, it's just bobhoye.com, chartsandmarkets.com. There's a couple of ways of getting in. And for the fun of being back with you, Jay, we're offering a 25% discount on new subscribers.
Okay.
And we've also put together a list of small cap gold stocks that we like. They range from producers, next to producers, and some exploration stocks in there. I think there's about a dozen. We monitor them technically as well.
Okay.
So folks should get in touch. The research has been reliable, and we're always delighted to talk with people. And then, as I say, we've got our list of small cap stocks that we're looking after. We're running the technicals on each one.
All right. Bob, I want to ask you just one real quickly now. You must think that oil is going to be coming down if you're bullish on the real price of gold. That's one thing. And the second thing is, and we just with less than a minute left, how do you know when we're at the top, the other end, when gold gets overvalued and we better start to exit? What do you look at? Do you look at that silver-gold ratio sometimes?
That one's been reliable, the silver-gold ratio. When the weekly RSI, relative momentum thing, gets up to 90, then that's a sell on the sector. And the last time it got to there was April 2011 on that fabulous speculation in the sector. And the only other time it got that high was in January of 1980 when that silver cartel went crazy and then crashed. So we will have, and then all here on the exploration side, Jay, you'll know the top is when some young promoters who don't know a clue about anything start promoting that property in Nevada that has so many holes drilled in it that when the wind blows, it whistles.
Okay. All right, we'll have to leave it go at that, Bob. We're out of time. It's really good having you again. We'll look to have you back again and keep us updated on where you think we're at in this gold market right now.
We'll keep you posted, Jay.
All right, thank you very much. Well, folks, that is it for this week. Next week, Michael Oliver will be with me. I don't know who my other guest will be yet. It'll be a good one, whoever it is. And so we hope to have you back then. Until then, goodbye and God's blessings to you.
Thank you again for listening to Turning Hard Times into Good Times with Jay Taylor.